That's pretty much all for tax. Now for the exciting bit with superannuation. A few changes here, nothing too dramatic. It's not like the 1st of July 07 when we had exceptional changes and pretty much an overhaul of the superannuation system. This is pretty much a bit of tinkering around superannuation. Let's have a look at what's been proposed and announced. Headline there, securing and protecting superannuation. I do support these changes here. They're good. At the times of uncertainty, we do need to get the people's confidence up in getting money into superannuation. A few changes here, pretty much administration. It does allow trustees now, again it applies from 1st of July 2012, allows trustees a greater use of tax file numbers to locate and consolidate members' accounts. So that's a good thing. A couple of other things. Employees will also then receive super contributions information on the payslips, so they will be able to track the amount of contributions coming through from the employers. And employees will also need to receive notification from the fund if regular payments cease as well too. So all up, what are the impacts? I guess it helps with the consolidating accounts. It helps with reducing the frequency of lost accounts. So it's all sort of coming together, if you like. Last but not least, we have promised excessive contributions. So hopefully with this, knowing that their contributions are coming through from employers on the pay slips, and if regular payments have stopped in terms of contributions, that would all help towards the management of excessive contributions, keep us on track, and remembering what contributions that are coming through. So all good, I think, in terms of administration-wise to secure and protect superannuation. Now this is the one that we've been looking all forward to. Not the excess contributions certainly, but how perhaps that could reduce the impact or refund of any excess contributions, concessional contributions, I must say. This applies from 1st of July next financial year. Unfortunately, it only applies to concessional contributions, so non-concessional contributions would still have a similar problem. So this only applies concessional, and unfortunately, it only applies a first-time breach only, so you can't do it consistently. If you breach it once, you might get away using this particular provision, and in fact, it's only a refund of only $10,000 too, and that's not going to be indexed. $10,000 of concessional contributions. The way I see it working is that if you get it refunded, then it will come out of the fund, but obviously it will be assessed as an income to you at a marginal tax rate. But I guess that's better than having to pay the highest tax rate on it. Now, give me an example there. Someone aged 50, and say, for example, we had $75,000 of salary sacrifice contributions, which means that we had $25,000 over. What this provision does allow us is $10,000 can be refunded, but will be taxed at a marginal tax rate. And which is fine because obviously the $75,000 would have been a deductible contributions. So $10,000 will be refunded, and that $10,000 will be then taxed as your normal assessable income. But the $15,000 will not be refunded, which means that $15,000 will be excessive. Okay, so $15,000 will still be excessive, so it doesn't provide for the full solution of it. $10,000 will be refunded, so again, we still need to watch out for that. $10,000 we still need to be watching out for that. On the $15,000 in this case, we will still have to apply the normal excessive contributions tax there. Unfortunately, the provision doesn't apply for breaches before 1st of July 2011. So therefore, anything that's happened up to next month would not be afforded any refund as far as this $10,000 rule is concerned. I don't think it's gone far enough, unfortunately. So that means, and it doesn't apply to non-concessional contributions as well too. So what I can say here is really we still need to exercise caution, and despite the fact that we do have this $10,000 refund possibility, it is also only for the first breach as well anyway. All I can say is we still need to exercise the same caution as we have been doing in the last couple of years moving forward. Certainly an improvement, but certainly would be an issue as well too. I've got a question that comes in relation to the refund. The question there is, so this can be used once. Absolutely right. So because the fourth point on the slide itself says available for the first breach only. So it'll be definitely be the case that you will not be for the second and third times. So one time only. So first time breach is all you've got for the refund of $10,000. Now, next slide is really trying to obviously looking at secure self-managed super funds. Quite a number of changes coming through, and I guess it's in relation to the number of funds which we can see being set up. At the last count, I understand there are some $430,000. 430,000 self-managed super funds out in the market there. So a significant amount and a significant more funds are being set up as well. Now, these changes, most of them will come through 1st of July 2012. I think I've seen a bill that just come through this morning. But in the absence of that, what I can say from the announcement is obviously they're reinforcing the whole sector. They're introducing administrative penalties that could be enforced by the ATO. They're looking at competency requirements, knowledge requirements for self-managed providers as well too. Looking at registration of self-managed auditors. So quite a number of changes there to consider. Looking at valuation of assets at market value, and ATO is going to help us out with some valuation guidelines as well. So most of these changes will come through 1st of July 2012. One particular change which will be interesting as well to consider is looking at the tightening restrictions on collectibles and personal use assets. So this will apply to new assets from 1st of July 2011, and all existing assets, collectible assets, will have complied by 1st of July 2016. So we will have to look at collectibles and personal use assets going forward. I think they are all pretty reasonable change, pretty good change. What the impact would be obviously there's a spotlight on self-managed super funds industry. What it has implied with the new changes are increased responsibilities for all parties, and I think it can only be a good thing. There has been lesser control, I guess, in the self-managed space. And if we make changes to rollover and registration processes, making sure that penalties involved, ensuring that our trustees, our members are aware that when they do self-managed super funds, it comes with a lot of responsibilities and understanding of the legal requirements. So with these changes, definitely ATO are getting a lot tougher with trustees, and more likely than ever to make funds non-complying. And at the last count, the ATO did make about 185 funds non-complying. That was pretty much unheard of in the past. But certainly the ATO are definitely getting a lot tougher with trustees, and very happy to make them non-compliant itself. As a question that came through, what's an example of a non-compliant collectible asset? Again, we haven't had much of a guidance. I did say that the bill came through this morning. I haven't had a chance to look at it as yet, so I will have to take a rain check on that particular one as to what restrictions are being placed on collectibles and personal use assets. So you can certainly wait for us to come through with that one there. Now, I had another question about the excess refunds. Some was under the impression that only amounts up to and under $10,000 will be refunded, and if you breach it by more than this, say $20,000, then you will not get relief for any of that amount. The full $20,000 would be taxed at excess rates. That's a very good question indeed. Again, I would take that on notice. I will need to check if the bill, as it comes through, whether that $10,000 will be, certainly if you exceed by $10,000, then you will get a refund, and certainly if you do more than that, you will not get it simply because you were over $10,000 in the first place. Right, that definitely is a very good point indeed. I would certainly take that on notice, and I would make sure that we confirm it one way or another. All right. Now, so that's all I need to say about self-managed super funds. Interesting times ahead, and we will need to monitor the changes there. Other super changes. Couple of things that I need to bring to your attention, not something too unexpected, I guess. Minimum payments for account-based pension. So the drawdown relief, the 50% discount that we've had in the last 3 years will be phased out. So in the next financial year, instead of the 50% reduction, we will get a 25% reduction instead, which means if the normal drawdown is 4%, it'll be down to 3% instead of 2% for the next financial year, and we'll be back to the normal drawdown percentages from 2012 onwards. The super caps for over 50, they reinstated or restated from 1st of July 2012 is when the 50,000 concessional cap will still be retained, but only for those with super balance of less than 500,000, and the caps will be increased as per normal through indexation, but otherwise it will be retained at 50,000, but only for those less than $500,000 in balance. Now, a couple of things to watch out for here. With the change in the minimum payments, obviously fund needs to ensure that we have sufficient liquidity to pay the increased minimum pensions. So watch out for that. We've had obviously the reduced amount for 3 years. That's going to change in the next year going forward. And with that 50,000, again, it's last chance I see to make sure, well, perhaps not last chance in terms of, we could continue doing this moving forward, is to consider super split just to try to keep the balance between husband and wife situation, to keep it below 500,000 if we can for as long as possible, so that we can have access to the $50,000 cap there. So those two changes which you need to bear in mind for the coming years. A couple of other changes here. The co-contribution frozen, and that's been the case. The proposal is for an additional year of freeze. So this is the big freeze on co-contribution. 2012-13 would remain the same, frozen at the two levels, 31,920 and 61,920, where it will then cut out. Another important change, which affects many of the self-managed funds, is the extension of the loss relief for super funds mergers. It's been given a relief there, 3 months extra to get it sorted out. So in terms of the impacts, don't forget, because of the frozen levels, then suddenly it's like bracket creep, isn't it? It's income creep, if you like. Then for clients who had improved income and post-GFC, clients would have obviously additional income, interest income, additional salary improvements, salary rise. Then they might find themselves that they may lose part of the co-contribution simply because the levels have been frozen. The funds. The other change with the temporary loss relief, obviously now allows 3 extra months for funds to restructure and retain their losses if they want to. So funds who in the past perhaps been considering this is the second chance, if you like, extra 3 months to restructure, roll into a wrap if that was the case needed to be. So 3 months, well, 4 months pretty much from now is one that you should need to consider if you're going to access the loss relief for the mergers.